I've been generating passive income every single week for the past 2 years utilizing a trading method called the wheel strategy. Today, I'm going to walk through exactly what the wheel strategy is and how to execute and start the trade yourself on Robinhood. There's a lot to cover in this video, so pay attention if you want to make some sweet passive income in the stock market. Let's go invest, everyone. Now, before we get into how to execute the strategy, you need to fully understand what the wheel strategy is. The wheel strategy is a two-step method that involves selling options contracts called cash secured puts and selling covered calls. This might sound like gibberish to you right now, but don't worry, I promise I'll make it really simple for you to understand, and feel free to ask any questions in the comment section down below throughout this video. So, what is an options contract? An options contract is an agreement between two parties to buy or sell an asset, like a stock at a preset price and date. Let's use an example to make this easier for us to understand. Let's say today is January 1st, and stock A, which is a stock that I really want to buy, it's trading at $10. But let's just say I'm not comfortable with buying stock A at $10. I'd much rather buy it for $9 instead. Maybe it's because I think the stock is going to drop in the near future. So I decide to sell an options contract that says the following. If stock A drops to $9 or below by next week on January 8th, then I will be required to buy 100 shares of stock A at $9 per share from the buyer of the contract on January 8th. When selling a contract, a premium is received. Premium is the price of the option contract that you are selling. This is the income that the seller receives for selling the contract. If stock A doesn't drop to $9 or below on January 8th, let's say it goes up to $12 instead, then I don't buy any shares and we move on with our merry lives. Think about it this way, everyone. This is a win-win scenario. I just sold a contract for $5 a premium. That $5 is mine no matter what. I got it on the day that I sell the contract to the buyer. I can do whatever I want with that $5. If the stock drops to $9 or below on the day of expiration, then I get to buy 100 shares of the stock that I really wanted to buy for a cheaper price at $9 per share instead of the $10 per share that it was trading at when I was first looking at it. If the stock doesn't drop to $9 or below and I don't get to buy any shares, then it's okay. I still made $5 a premium, and guess what? I can just move on to the next week and sell another contract for more premium instead. This type of options contract is called a cash secured put, which is an agreement to buy 100 shares of a stock at a specific price. This is the first step of the wheel strategy. This next step is actually the exciting part of the wheel strategy, and it's where the real money-making potential starts. So let's continue with our previous example. Let's say today is January 8th, and we just bought 100 shares of stock a stock that we wanted to own at $9 per share. Let's go. Obviously, I now want to sell my shares for a higher price than I originally bought them for. So I can now sell an options contract for a set price, let's say $5 a premium, that says the following. If stock A rises to above $11 a share by next week, then I will be required to sell my 100 shares to the buyer of the contract on January 15th. If stock A doesn't rise to above $11 a share, then I get to keep my shares and we move on again. This is also another win-win scenario. I just sold a contract for $5 a premium, similar to the cash secured put scenario. This $5 is mine no matter what. I can use it for whatever I want. And on top of this, if the stock rises to above $11 a share, then I sell my 100 shares of stock A that I originally bought for $9 for $11 per share, for a sweet profit of $200. If the stock doesn't rise to $11 or above and I don't get to sell my shares, it's all good, since I get to keep my shares of stock A and I already made $5 a premium from selling the contract. I can just move on and sell another contract the week after for more premium until I eventually sell my 100 shares of stock A at a premium. This type of options contract is called a covered call. It's an agreement to sell 100 shares of a stock at a specific price. I hope you're starting to see the income generating potential in the wheel strategy. I can continue to sell cash secured puts until I need to buy 100 shares of the stock that I want to own, and once I own 100 shares, then I can continue to sell covered calls until I eventually sell my shares for a profit. And guess what I would do afterwards? I start selling cash secured puts again until I own 100 shares, and then I continue to sell covered calls again, rinse and repeat. Let's break down the profits in a hypothetical scenario using the example with stock A. On January 1st, we started the wheel on stock A. We make $5 of premium on January 1st from selling a cash secured put options contract. On January 8th, stock A drops to below $9 per share, and we end up buying 100 shares of stock A at $9, which costs us $900. Now that we own 100 shares of stock A, we make another $5 of profit from selling a covered calls options contract as an agreement to sell our 100 shares at $11 per share if the stock rises to above the set price. On January 15th, stock A rises to above $11 per share, and we end up selling our shares at $11 per share for an awesome profit of $200. This brings the total from this trade to a profit of $210. $200 from the profit of selling our shares, $5 from selling the cash secured put, and $5 from selling the covered call. Since we bought stock A for $900, this would be a 23% return on investment in a 2-week scenario. That's an amazing return on investment. Granted, everyone, this is just a hypothetical scenario, and stock prices definitely fluctuate, but I hope you're starting to see the income generating potential in this strategy. It's also important to understand the risks of the wheel strategy, just as it's important to understand that any investment comes with risk. Am I okay with holding this stock or fund for a long time in the case that the stock price trends down for a while? There's a real chance that the stock that you choose can trend downwards for a foreseeable future, but you can still generate income through selling contracts as long as you are holding 100 shares of the stock. This is the benefit of selling covered calls. The second question that I like to ask myself, is this a stock or fund that I genuinely want to own? Don't start choosing random stocks that you don't understand or have never heard of. You would never do this if you were just buying stocks or assets normally, so you especially shouldn't do this when you're trading options. Please do not trade option strategies on speculative stocks or assets that have a high possibility of going bankrupt. Make sure you do your due research and see if a company has strong financials or has a good reputation for treating its shareholders well. If the stock or fund goes bankrupt, sorry, you gotta say goodbye to your money. But this would be the case if you were to buy any sort of stock normally anyways. I'm actually gonna show you exactly how I started the wheel strategy in the $3,000 Robinhood portfolio challenge that I mentioned before. Enjoy and feel free to ask any questions in the comments below. Welcome to the $3,000 portfolio challenge, where I will be showcasing the wheel strategy using Robinhood. Step 1, navigate to Robinhood stock, in this case it's Hood. Step 2, click on trade and press trade options. Step 3, navigate to your desired expiration date. I like to do weekly, so in this case it's February 17. Step 4, click on the sell options tab and select the puts tab. Step 5, select your strike price. I'm going to sell a $9.50 strike put option and collect that sweet premium of $13. Click review, swipe up to submit. That's the first step to opening up a wheel strategy. Now, while there are risks to the wheel strategy, I personally believe that this is one of the safest methods of investing, which I have documented on my Instagram page linked down below. Please don't just copy along with what I do, and remember to do your due research before investing any of your own money. There's a lot that I covered in this video, and I completely understand that, but I hope you're excited as I am for what's to come. Please subscribe, like the video, and comment any feedback or ideas for the channel. And as always, let's go invest, everyone.